Welcome to the deep dive. Today, we're getting into something pretty interesting in decentralized finance, DeFi derivatives specifically, and, well, a new approach trying to fix some of the problems we see now.
Right. I mean, we have on-chain perpetuals, sure, but they often don't quite measure up to what you might find in traditional finance,
Oh,
flexibility-wise.
exactly. A lot of the current decentralized perp exchanges, they kind of just copy the TradFi models, don't they? Without adding huge DeFi native benefits.
That's a fair point. Just putting the old model on-chain isn't necessarily innovation.
So that brings us to InfinityPools. It's a new DX, and they're making a pretty bold claim, actually, saying they can be like 10 times better than what's out there now, both on-chain and even off-chain perps.
10 times better is, well, that's a big statement. What are they basing that on?
Okay, so their key features are definitely eye-catching. They're talking about basically unlimited leverage, trading almost any asset, no liquidations, that's a big one, no counterparty risk, and maybe strangest of all, no oracles.
Wow, okay, no liquidations and no oracles.
Hmm.
Those alone, if they pull it off, would be,
Mhm.
yeah, a fundamental shift in how DeFi derivatives work.
Definitely. So to really understand what's going on, we actually talked with Metu. He's the co-founder and CEO of InfinityPools. His background's pretty solid, Columbia Comp Sci, then quant work, research, product management.
So a mix of deep tech and finance.
Yeah.
That makes sense for tackling something like this. You need both perspectives.
For sure. Now, Infinity Pools is still in beta right now, so our goal with this deep dive is to really unpack the design, figure out how it works and what it could actually mean for you, the user. So let's get into it.
Yeah, let's start at the beginning. Where did this idea even come from? What problem were they trying to solve that led to this specific design?
Right. Well, Metu's crypto journey started kind of like a lot of OGs. He was mining Bitcoin from his dorm room back in 2014.
2014, wow. Okay, so he's been around the block, seen the cycles. That early hands-on experience matters.
Totally. So fast forward to around 2020, Metu and his team, they saw this trend coming. They really believed DeFi derivatives were about to explode. They even got some initial funding based on that idea for a different protocol, actually.
Timing makes sense.
Yeah.
2020 was a big year for DeFi growth, and derivatives were definitely part of the conversation. Investor interest was high.
But here's the twist. They looked around at the on-chain perps that were popping up, and they realized, these aren't really that different. They felt like they were mostly just copying the old TradFi futures models onto the blockchain.
Which, as we said, isn't necessarily taking full advantage of what DeFi can do, right?
Yeah.
Just replicating isn't always improving.
Exactly. So they pivoted, big time. They asked themselves a more fundamental question. How can we make futures trading feel as seamless and, as efficient as trading spot assets? That question basically forced them to rethink everything and led to the Infinity Pools architecture.
That's fascinating. Going back to first principles like that, instead of just tweaking the existing perpetual future model, they question the model itself. That's often where real innovation comes from.
Yeah. And apparently getting that first round of funding wasn't too hard because investors did believe in the whole derivatives growth story. Though, Metu did say they now see it as maybe more of a 5-year horizon for that massive explosion, not immediate.
Which seems realistic. These things take time to mature, for the tech to catch up, for users to adopt. A longer-term view probably makes sense.
Okay, so let's dig into what actually makes Infinity Pools different at its core. The main thing to grasp is they really rebuilt the idea of a derivative from the ground up. It's not just the old perpetual futures or like a one-day rolling future analogy anymore.
Right, they're not just iterating, they're trying to fundamentally change the building blocks.
The key difference is what's happening behind the scenes. So on the front end, when you trade, it looks like a normal Perps platform, long, short buttons, all that. But the back end is actually using rolled over options.
Options, interesting. So they believe options are a better primitive for building these kinds of derivative exposures.
That's their argument, yeah. More flexible, more adaptable for what they wanted to achieve.
Options do offer different ways to structure risk and reward compared to futures. So using them as the underlying engine. Okay, kind of can see how that could lead to different outcomes.
And Metu actually showed us the beta interface. If you're watching on YouTube, you'll see it. Looks pretty familiar long short. Deposit your collateral. Initially, it's ETH or USDC for the ETH-USDC pool, but they plan multi-collateral later.
Okay, so keeping the user experience familiar is smart. Reduces the learning curve, even if the mechanics underneath are new.
But here's where it diverges again, and it's the really big one. 0 liquidations. Gone. Instead, what you see as a user are things like an interest rate hourly, and an estimated time to close.
No liquidations.
Okay.
That changes everything for leverage trading, doesn't it?
Yeah.
Shifting away from that sudden, often painful liquidation event.
Totally. So say you go in with really high leverage, like 700x or something crazy. That estimated time to close basically tells you, okay, at the current interest rate, and if the price doesn't move in your favor, your collateral will last for this long paying the borrowing cost.
Ah, so it's like a countdown timer for your position's sustainability based on the cost of leverage, not a specific price trigger.
Exactly. It's completely different from getting stopped out by a liquidation engine hitting a certain price. And, crucially, there are no liquidation penalties either. Metu actually argued that stop losses are a much better way for you to manage your own risk proactively.
That makes sense. It puts the control back in the trader's hands to define their exit point rather than relying on the platform's potentially harsh liquidation rules. More agency.
Another interesting bit they're integrating with 1inch, initially at least, to tap into spot market liquidity for executing the trades. The idea is to get you the best execution price, maybe even positive slippage sometimes.
So they're using external DEX liquidity for the actual asset swaps that underpin the positions.
Yeah, and they said they're open to using other DX aggregators too, as long as the whole process, the transaction, can happen atomically, like all in one go.
Right. Atomicity is key for that to work seamlessly and without risk between protocols. Using aggregators leverages existing deep liquidity. Smart.
Okay, so let's get a bit more technical. How does a trade actually work under the hood? Say you want to open a long position.
Yeah, let's trace the steps. This is where the innovation really lies, I imagine.
So first, the back end gets your order. Then it looks at the liquidity available inside the InfinityPools AMM, their own automated market maker. It figures out which liquidity provider positions, LP positions, can give you the leverage you want at the best possible interest rate. Metu called it like a Uniswap router for interest rates.
Okay, so it's routing the borrowing demand to the cheapest source of capital within their own AMM pools. That's clever. Optimizing the cost for the trader.
Right, and let's use an example. Say you want to long ETH, and you're using USDC as collateral. The system doesn't directly borrow ETH for you. Instead, it borrows USDC-backed LP tokens from their AMM.
Borrows the stablecoin liquidity.
Okay.
Then it immediately takes that borrowed USDC and uses 1inch to swap it for ETH on the spot market. Boom, you now have your leveraged long ETH position.
Got it. So the leverage comes from borrowing liquidity within their system, and the exposure to the asset comes from an external spot swap, so a two-step process internally.
Exactly. Now, what about closing? Let's say you made a profit on that long ETH position.
Yeah, getting out is just as important as getting in. How does that work?
You'd basically sell the ETH you acquired. You take your profit, and then the remaining collateral is used to effectively mint back those LP tokens you originally borrowed, returning them to the AMM.
Okay, so it unwinds the process. Sell the asset, repay the internal loan by returning the LP tokens. Clean.
But what if the trade goes sour? The market moves against your long position. That estimated time to close we mentioned. It'll start going down faster.
Right, because the cost of holding the position is eating into your collateral more quickly, or maybe unrealized losses are contributing to. Yeah, exactly. Unrealized P&L affects it. If you decide to close at a loss, you sell your ETH, but you get back less USDC than the initial implied loan value. But crucially, your loss is capped. It's limited to the collateral you initially put in.
And that's the no liquidation penalty part in action. You don't get hit with extra fees for closing underwater. Your loss is just your loss, up to your initial stake.
Correct. And there's another layer. If the ETH price drops way down, below where you effectively borrowed from the AMM has a mechanism, so the liquidity provider still gets back the right value effectively in the underlying asset. It helps ensure the LP doesn't lose out unfairly and further caps the trader's loss.
So there are safeguards built into the AMM logic itself to handle those edge cases and protect both sides to some extent.
And just to be super clear on the estimated time to close, that initial calculation assumes the price stays flat. If the price moves against you, your unrealized losses effectively get used to pay the interest, so the time shortens. But if the price moves in your favor,
your unrealized profits could actually extend the duration, maybe even indefinitely if the gains significantly outpace the interest cost.
potentially, yeah, your unrealized P&L can help sustain the position for longer.
Okay, that dynamic aspect is really interesting compared to a hard liquidation price.
Now, about that no oracles claim, this one really made me pause. DeFi usually relies heavily on oracles for price feeds, right?
Yeah.
for borrowing, lending, liquidations. How do they get around that?
It's a huge challenge. Oracles are often seen as a central point of failure or manipulation risk. If they truly solve this, it's significant.
Well, for the swaps, like when they use 1inch, they don't need an oracle because they're just getting the real-time market price directly from the DEX they're trading on.
Right, that makes sense. They inherit the price discovery from the spot market for the actual execution.
Yeah.
Okay.
But what about for the internal stuff, the borrowing, the lending, and, crucially, figuring out when your time is up without using an external price feed? For that, they rely entirely on the internal pricing of their own InfinityPools AMM.
So the AMM's own pool ratios and internal logic determine the relative value of the assets and the borrowed LP tokens. A bit like how Uniswap prices assets based on pool balances, without needing an external oracle for its core swap function.
Exactly like that. The system monitors the value of the borrowed LP tokens based on what the AM itself thinks they're worth, based on its internal state. That's how they avoid external oracle dependency for the core lending borrowing mechanism.
Fascinating. So the price risk is managed entirely based on the internal state of their own AMM. That's a bold design choice. It avoids oracle risk, but relies heavily on the AMM functioning correctly and reflecting market reality reasonably well.
Definitely relies on the IMM. Okay, let's switch gears. What about the other side? The people providing the liquidity, the LPs, they have an earn section for this, though it was still being built out when we spoke.
Right, the LPs are critical. No DAX or AMM works without liquidity providers. How do they incentivize them, and what's the experience like?
So as an LP, you deposit the tokens for the pair, like Lincoln USDC for a LinkUSDC pool. Pretty standard. But what's cool is they have these price range sliders. You get to choose the specific price range where your liquidity is active.
Concentrated liquidity, like Uniswap D3. That allows LPs to be much more capital efficient, potentially earning more fees if the price stays within their chosen range.
Yeah, Metu said beginners might just want to provide liquidity across the full range to keep it simple, but more advanced LPs can set tighter ranges for potentially higher returns. The idea is you get paid fees when trades happen within your range. He sort of compared it to selling options.
That analogy makes some sense. You're providing liquidity within a specific price band, accepting the risk the price might move outside it, and earning fees, like a premium, while it stays inside. It's not literally selling options contracts, but the risk-reward profile has similarities.
And a key metric for LPs is the utilization ratio. This tells you how much of the liquidity in your specific price range is actually being borrowed by traders to take on leverage.
Okay, so higher utilization means more of your capital is being actively used in trades, which should translate to higher earnings for you as an LP, right?
Exactly. The LP returns actually have two parts. There's a base floor rate, kind of like that auction premium idea, and then an additional yield that scales up with the utilization rate. So high demand for leverage in your price range means better potential returns.
That's a good incentive structure. Rewards LPs for providing liquidity where it's most needed by traders.
Of course, being an LP isn't risk-free. You still have the standard AMM risk, impermanent loss.
Right, the classic IL. If the prices of the two assets diverge significantly, the value of your LP position might be less than if you just held the assets separately. It's the cost of providing liquidity in a fluctuating market.
They also have a really unique withdrawal system for LPs. You can withdraw immediately, but you pay a small fee. Or you can choose a free withdrawal, but there's a waiting period. It's an exponentially decaying wait, but you get everything back in under 7 days.
A time-delayed free withdrawal. Why do that?
The idea is to discourage massive LPs from doing just-in-time liquidity, basically jumping in and out really fast just to capture quick yield spikes, which can destabilize things for smaller, longer-term retail LPs. This delay mechanism is meant to protect yields for the average Joe LP.
Interesting. A way to combat mercenary capital and promote more stable liquidity provision. That could be appealing to retail.
Plus, they suggested yields might be higher than, say, Uniswap, because LPs might still earn some fees, even if the current price drifts slightly outside their set range, as long as utilization occurred within their range during that period.
Oh, that's different. So you're not immediately out of the money the second the price ticks outside your band. That could definitely enhance returns.
And one more thing on LPs, Metu mentioned they want to work with zero market makers.
Zero market makers, as in no professional firms actively quoting prices. That's unusual for a derivatives platform.
Yeah, the idea is that maybe without those sophisticated HFTs and arbitrageurs acting as direct counterparties, regular traders might get slightly better pricing or execution.
It's a gamble. Market makers usually tighten spreads and provide constant liquidity, Relying purely on passive AMMLPs could lead to wider spreads sometimes, but maybe less. Predatory pricing. It's a trade-off.
Definitely a trade-off. Okay, nearly there. What about tokenomics? Is there going to be an InfinityPools token? That's always the question in DeFi.
Yeah, especially now with all the discussion around tokens like UNI and others. Does the protocol need its own token? What will it do?
Metu said they're definitely thinking about it, acknowledge the whole debate, the exact role, the mechanics, it's all still under consideration. But possibilities include things like fee sharing, maybe for both equity holders and token holders.
Fee sharing is a common utility, and using a token for governance or as an incentive for growth.
That was mentioned too, yeah. Using it as a lever for growth and obviously for governance, letting the community have a say in the protocol's future. Pretty standard potential use cases.
Makes sense. Aligning incentives, decentralizing control over time. That's the typical playbook.
And finally, the roadmap. When can we actually try this? He said testnet was expected really soon, actually, before the end of 2023, based on when we recorded this. Mainnet target was Q1 2024.
Q1 2024.
Okay, but, he was realistic, acknowledged it's complex, it's new, so delays are definitely possible.
As they always are with ambitious tech builds, especially in crypto, better to launch securely than quickly.
Absolutely. So, wrapping it up, the core pitch from InfinityPools is really powerful. No liquidations, high leverage. If they can make it work smoothly and securely, it really could change how people trade derivatives in DeFi.
It's a compelling vision, removing that liquidation fear while still offering high capital efficiency through leverage.
Yeah, it addresses major pain points. Execution will be key, of course.
For sure. If you want to keep tabs on them, the website is infinitypools.finance. You can sign up for email updates there. And their Twitter handle is INFPools, INFPools.
Good to know. Following the official project sources is always best for updates. Definitely want to say a huge thanks to Metu for walking us through all that detail. Really appreciate him taking the time. We're absolutely looking forward to maybe getting an update once it's live and people are actually using it.
Yeah, it was a great explanation of a genuinely novel approach. It's always exciting to see teams thinking differently about core DeFi primitives.
It really feels like an exciting time again. You see things like InfinityPools, other innovations like Instadapp Fluid we've looked at. Maybe 2024 really could be a year where DeFi takes another big leap forward.
I think so. This convergence of lending, borrowing, derivatives, AMM tech.
Yeah.
It's all maturing and leading to more sophisticated and potentially user-friendly financial tools built on chain.
So on that note, here's something for you to chew on. If liquidations and their associated penalties disappear from leverage trading, how does that fundamentally change how you think about risk management? What new strategies become possible or even necessary? Definitely something to ponder. Thanks for joining us on the deep dive.